Hey everyone, my name is Kenji and I want to make this video to explain the key differences between commercial banking and investment banking. So just taking a step back and looking at banking on the whole, basically banking would be an intermediary between those who have money and those who need money, linking them up, and that's basically what banking is. Now within that, it's divided into two main categories, the commercial banks and the investment banks. So let's get into the main differences between the two. The first main difference is the customers they serve. Between commercial banks and investment banks, there's a clear split. So let's start with the one we're most familiar with, commercial banks. They deal, like I mentioned earlier, with people like you and I, and small and medium-sized companies like, say, your local coffee shop, for example. They may also deal with some larger companies, but that's not really their biggest focus. Now, some examples of commercial banks can include Capital One in the US or NatWest in the UK. And then on the other hand, we have investment banks. And these typically don't work with normal people like you and I. Instead, they only work for larger players like big companies, institutional investors. An institutional investor is an investor like a pension fund, a mutual fund, for example, governments, and some high net worth individuals. When I say high net worth, I mean like a really rich person, someone that has well above $1 million mark. And some examples of investment banks might include Evercore and Morgan Stanley, and they typically have offices really all across the globe in the main financial cities like London, New York, or Hong Kong. Now let's look at some of the differences in the services they offer. On the one hand, for commercial banks, one of the main services is accepting deposits. So if I make some money, I might leave it there. And secondly, taking out loans. So it could be a loan for a mortgage, a car, or whatever. And then some secondary services can include things like credit cards as well as foreign exchange. So it's really quite simple on the whole. Now, on the other hand, the services of an investment bank are typically a lot more complex and they're a lot more personalized. So there's really two main splits. The first one has to do with advisory and the second one with financing. So when we look at advisory, for example, this has to do with should you merge or acquire another company, which is called M&A, should you restructure your business because it's not doing very well, and other things along those lines. For financing, that has everything to do with raising money, right? So for example, you might tap into the financial markets, you want to sell stocks, you want to sell bonds, but you're not really sure how to do that. That's when an investment bank comes in to help you out. They also have some other services, which might include things like trading, right? They can either trade their own money or trade other people's money. And then they also have research. So in research, they typically conduct economic research, which is what they're very good at and they're very knowledgeable. So those are really the main services that they offer. Now looking into how they actually make money. So commercial banks make money by lending to borrowers with an interest rate above what they pay to depositors. So let's look at an example to make it a bit more clear. So suppose a depositor has been paid $1,000 this month, that's her monthly salary. So she's put the money in the bank. In turn, the bank pays her a 2%, say, for trusting them with the money. So what does the bank do with the $1,000? They just leave it? No, they actually decide to lend it out to someone else that needs it. Say in this case, this person wants to borrow $1,000 for education. So once they have that, in turn, that person has to pay a 5% interest rate, say. So the difference between what the bank pays in interest and what they get in interest, which is known as interest income versus interest expense, is what gives them that 3% spread. And that's basically how they make their money. Now this concept would also apply to businesses, right? It wouldn't just be this lady and this man, it could be a business as well. And as mentioned earlier, they also have some other services like exchanging currencies or credit cards where they might also take fees for that. Now, on the other hand, we have investment banks, and investment banks mainly earn money by charging fees and commissions. So let's look at an example. Suppose company A over here wants to sell its shares to the public market because they're short in cash and they want to continue growing. So let's say that they want to sell 10 million shares. Now, the investment bank will underwrite these shares. That basically means that they pledge to buy all of the unsold shares. So they take on the risk for those 10 million shares, basically. So the bank will then take these shares and ask for a price to all the investors out there in the market. Once they debate on a price, they'll finally agree to something like, say, $25 per share in this case. So for company A, that's gonna be $250 million that they raised minus whatever the investment bank takes. Now, what will the investment bank take? So that's, let's say, a 3% fee. So they basically made $7.5 million through this transaction. And that's really one of their main ways that they make money. So just like that previous example, the same thing applies for, say, selling bonds, for example, or other financial instruments. And then, as I mentioned earlier, they might have advisory fees. So they might take a fee for giving out that advice. That's one thing. For trading, they either take a fee for managing that money, or they might take a percentage of the profits as well. And then lastly, with economic research, they're basically going to sell those research papers, say. So based on that, you can probably picture that commercial banks actually have a lot more clients than investment banks do, because they deal with everyday regular people, right? But the money they make on each of those is actually a lot less. So per customer, they earn a lot less money. Then on the other hand, investment banks have very few customers, but those few customers earn them the big bucks, right? So it's a bit of a difference in business models here. The last key difference that I want to touch on has to do with risk and regulation. As you can probably tell by now, commercial banks and investment banks are very different models, and so they don't have the same regulators. Let's take the US for example. So there's typically, for commercial banks, there's a bunch of different regulators. Among them is the Federal Reserve, the Fed it's called, as well as the Federal Deposit Insurance Corporation, FDIC. And so what these essentially ensure is that one, the bank doesn't go bust, and two, people's money stays safe, right? And overall, these regulators and the government on the whole actually ensures a certain amount of money for depositors. So for example, if I have $5,000 saved and this my bank were to go bust, then the government would actually cover and kind of refund me for that money. And so as you can probably imagine, it's very well regulated because, well, the government doesn't necessarily want to be paying out that money, right? As for the investment banks, they don't have the same regulation at all. And mainly that's for two reasons. Number one, they don't really deal with regular people like you and I, and so not the same thing applies to them. And number two, it has to do with the fact that their services are a lot more personalized, and as such, it's a lot harder to regulate, at least regulate effectively. Their main regulator, at least in the US, is the SEC, the Securities and Exchange Commission. In terms of risk, a commercial bank has a lot lower of a risk exposure. When you think about it, one, it's much more regulated and they need to have certain cash reserves, for example. And number two, when you as a client go to deposit your money, you're not really hoping to get rich just by leaving the money there. Instead, you're hoping that it's going to be secure. And as such, the bank doesn't take too much risk, right? Now, on the other hand, for investment banks, these are a lot more risky on the whole. Basically, as a client there, say a big company going in, you're hoping that they're going to be able to raise money, they're going to be able to create value for you, and as such, they need to take bigger risks. Now, we've looked at both commercial banks and investment banks, but to be honest, sometimes that split isn't so clear, and that's because of universal banks. These are basically the biggest banks in the world, and they actually offer both commercial and investment banking services. These are the big household names, the ones you see in the movies, like say JP Morgan Chase, which was actually a merger of one, JP Morgan, which was an investment bank, and two, Chase Bank, which used to be a commercial bank. Other examples of universal banks might include Deutsche Bank or HSBC. So why would commercial banks and investment banks want to merge? That basically has to do with trying to be a one-stop shop where you can have both commercial and investment banking services to enhance the customer service and in turn make more money, right? Now, traditionally, commercial banks and investment banks were actually separate. Legally, they were meant to be separate. This was called the Glass-Steagall Act, and it came into action around the 1930s, 1940s, just after the Great Depression. And it was around up until, I think it was 1999 when the act got repealed. And ever since, that's why we have universal banks today. And back in 2008, this came into a lot of controversy, mainly because of the financial crisis, and some of the blame was put on this act. But to be honest, this is not something for this video, and maybe I'll cover it in a different one. So there you have it. Those are the key differences. I hope you found it helpful, and I'll hopefully catch you in the next one.